Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Nikolai Ray. Thanks for being on the show, Nikolai.
Hi, Whitney. Thanks for having me.
Nikolai is a real estate tech entrepreneur, multifamily investing thought leader. He's a keynote speaker for real estate, blockchain, entrepreneur events, and podcasts. I've had the pleasure of meeting him at a couple different conferences this past year, and knew that I had to have him on the show, that he'd be a great guest, and he's able to provide lots of just great tips and insights of how he's grown his business, and looking forward to this interview. Nicola, would you give us a little of your background, how you became an entrepreneur, and how you got into real estate syndication specifically?
Absolutely. It's kind of a long story, and I'm going to try and make it as short and concise as possible. But it actually probably started before I was born. So I come from a prominent Indian family in the northeast of India, in an area called Bengal. And I come from a family that was always pretty much a pioneer of industry, of science, and of business. And this goes back, not only in the last century, but in the last 200, 300, 400 years. So I think that's kind of where it comes from, because I grew up in Los Angeles, even though I'm from Quebec. I grew up in Los Angeles in the 80s. My parents were artists. My dad was a musician. My mom was a theater actress, and lived a very kind of bohemian, West Coast, laid-back lifestyle where, there wasn't any seed for entrepreneurship or for building something at an international level. So that's why I kind of think that it comes more from genetics, probably, because at the age of 4, I have a very clear memory, and I like to talk about this a lot, is, we were walking in the downtown area of Los Angeles, which was a pretty bad place in the 80s. Like, it's gotten nice now, but it was awful in the 80s. And so I think we were going to a restaurant or something with my parents, and I was only 4 years old, and I had this like epiphany, and I can still remember it very, very clearly. I had this epiphany, and I said to my parents, I looked up at all the skyscrapers, and I said, one day there's going to be a skyscraper in every major city in the world with my company's name on it, and I'm going to help clean up the streets and feed the homeless and give them shelter. So that's where my entrepreneurship kind of started from. Obviously, as life goes on, we live in a very capitalistic society. That I kind of got away from those ideals, and from that kind of perfect vision of what life should be. And I live in society. I don't live I'm not a monk on a mountain. So grew up in Los Angeles, ended up becoming a hockey player, played professional hockey till the age of 22, and was kind of at a crossroads. I was in the minor leagues, wasn't making it to the NHL. So I had to make a decision. Do I still play minor pro until the age of 35, 40? Or do I do something else with my life? And at that moment, at 22, I already had a degree in biomechanics and a minor in nutrition, and was about to do my postgrad in preventive medicine at Harvard with the Harvard Extension School. And, I decided that, being a minor professional hockey player just wasn't cutting it for me. So I became kind of a would-be entrepreneur without really knowing it. So at that moment, I was training in a gym where I was playing hockey, and there were no trainers, no kinesiologists, no exercise science coaches. And so the owners of the gym said, hey, we'll give you an office. How about you just, make programs for people and help people out, because there's no one really to do that here. So, and we're not going to charge you anything. And you're here playing hockey, everyone knows you. And, you have your weekdays off because, you guys play on the weekends and practice at night. So I was like, okay, I'll do that. So did that. Within a month, had my first employee, and finally and quickly understood what it was to start to delegate. And I was like, oh, I can get a hang of this. And that business grew to 75 employees in 2.5 years in 3 cities. So, and that was before the age of 25. So that's really how my entrepreneurship career got started. Just kind of to sideline to understand where the real estate comes from. Studying in biomechanics means that I'm a pure mathematician, so I'm used to doing mathematics in 3 dimensions. So obviously, like, underwriting properties in Excel is something quite simple for me. And I come from a long family of mathematicians, of even like Nobel Prize laureates in mathematics and science. So it's very intrinsic for me to be good in math. So when I was about 17 or 18, when I was 17 or 18 playing hockey in junior hockey, I was kind of bored, and I got a couple $1,000 inheritance, and I started mirroring one of my dad's friends who was a swing trader at the stock market and the Forex market. So I just mirrored him and actually turned that 5,000 into a couple $100,000 quite quickly. So knowing that I didn't know what I was doing, that I was just copying someone, and he was like, okay, maybe you should start to learn what you're doing instead of just copying me. So I was like, okay, I'll do something else now. So I ended up investing with my buddies who were buying their first multifamily properties. I was lending them their down payment with my money, which made me learn how to underwrite deals at a very young age. We're talking about 18 years old. So did that passively for about 4 years. And then obviously with the business story I told you earlier, I reoriented my real estate money back into my business as it started growing. So I actually didn't do real estate from the age of 22 to 27 because I ended up building 3 businesses. So I built that first business, like I told you. I built a second business, which was a hockey player agency, obviously being an ex-pro hockey player and having all those contacts. So we represented players in their contract negotiations and all their representation financials. And then at 27, after I had sold that business, I started a real estate investment bank. So what we were doing was we were full real estate advisory services, doing brokerage on the transaction side, on the financing, on the tax planning, and all the strategic planning. And I built that business up to an ATV of $100 million within 3 years, and ended up selling that business also. And then started at the age, I guess it was in 2016, so about 2.5 years ago, started the business that I'm running right now, which is called the MREX, for Multifamily Real Estate Exchange. And what that is ultimately, it's a real estate tech company, and we also have an education wing and we have an events wing for multifamily real estate investors. And throughout all that, I also worked as an ultra high net worth advisor in multifamily real estate. So I worked with some family offices, worked with some really wealthy individuals who wanted to place capital in multifamily. So I acted as their discretionary advisor, pretty much doing everything from searching for the deals, visiting the properties, overseeing the inspection of it and all the due diligence, and actually signing off on the final transaction and all the financing. So doing that, I've worked on about just over $1 billion in multifamily real estate transactions, acquisitions, dispositions, and all that stuff. So that's it. That's it in a couple minutes in a nutshell. I think that's the fastest I've ever told that story.
Well, that's an impressive history and how you got into the business. So, to the person that's listening that says, "Oh, wait a minute, you're so far ahead of me. You're so, you've done all these things. It's so impressive. I just don't ever see myself getting there." But I'd like to go back to that point where you said, you found your buddies and you said, "Okay, I'm going to invest passively with them." How did you, or what gave you the confidence to really start investing with them and then start, go out on your own, after that?
Well, obviously, I've always been a pretty confident person at the start off, so that definitely helps. I think also knowledge is a very important factor. I think a lot of people are trying to get into multifamily, whether it be as a syndicator, as a GP, or more of a passive investor like an LP. I don't think people are investing enough in their knowledge, because multifamily real estate, even though a lot of like these guru seminars and media outlets make it look to seem pretty simple, and it actually used to be a pretty simple business. Today, it's actually quite complex, and it's becoming more and more complex as it's getting more financial. There are more people like me, a lot more private equity, a lot more smart money, Wall Street money, high net worth money, and even mom and pop investors now are not just mom and pop investors. They're mom and pop investors who have, master's degrees in finance and who worked at investment banks or who were high-level entrepreneurs. So it's become a very sophisticated market, because multifamily, compared to, say, commercial real estate or compared to the stock market, has always historically been a very kind of entry-level, kind of we're gonna wing it kind of market, and now it's getting very complex and very financial. And obviously, with raising interest rates and compressing cap rates, that makes it even more complex. So I think knowledge, investing in your education, even if you're just a passive investor, I think investing in your education and understanding at least basic real estate financial engineering and underwriting and mathematics, I think is really where the confidence comes from, and also knowing yourself and taking time to get to know the people who you're doing business with. Because being a mathematics guy, a lot of people think, okay, he's all high level in the clouds, kind of, analyzing this stuff. But one must not forget that real estate is a very human investment class compared to the stock market, where, because you have an active duty towards your property, or even as a passive investor, you're investing in a human being and a property. There's that human component and that relational component that is so, so, so important. So I think the knowledge that you develop for yourself, and also the energy and time that you invest in that relationship, and really weeding out the relationship to make sure that you have confidence in your general partner, or if you're the general partner, that you have demonstrated your confidence and that you're showing it to your passive investors, well, then that synergy and that fusion that comes from that human side of things, plus the knowledge, is what really allows investors to be successful both on the passive and the active side. What's the best way you educate yourself? I think there is no best way. I think the worst way is to educate yourself by trying to just kind of do it and wing it. Like a lot of people will just be like, oh, I'll just buy my first 8-unit property and I'll just kind of learn by doing. I think that's probably the worst way to learn. I think it's the best way to gain experience, and that you must obviously gain experience, because a lot of people are just kind of bookworms and never actually buy property, so they never really build that experience up. But I think it's a mistake to think that you need to learn by doing. I think you need to learn by learning. So you need to, depending on what your learning capacity is, some people learn faster than others. Some people are more audio learners, some are more visual, some have to read, some have to actually do exercises. So I think, it's really about knowing yourself. So I think obviously reading is I'm a very big reader. I probably read, 30 to 50 books a year, even though I'm already at a very high level. I continue on reading. Obviously real estate seminars, conferences, we've met at a couple conferences and seminars. And I think, even if you go to one of those seminars and only come out with one small nugget of information or a relationship, I think it's definitely worth the money invested. Obviously going to courses and educations. The thing is that you have to really weed out the good from the bad, which is more of a difficult thing to do. But I think, it ultimately comes down to your own learning style and the way that you like to learn. So your company specifically focuses on multifamily, correct? Exactly, right. We focus on multifamily. We have an events wing where we hold peer-to-peer events in the multifamily space. So just to give you an example, in 2019, we'll be holding 2 prime events. One's called the Multifamily Real Estate Week, and the other one's called the Multifamily Real Estate Summit. So the week, obviously, is pretty self-descriptive. It's a week long of activities, kind of inspired after TechCrunch's Tech Week. And we'll be holding that actually in 10 cities. So we'll be in Montreal, Toronto, up here in Canada, obviously because I'm Canadian, so got to show us Canadians some love. We'll be doing the 4 major markets in Florida, so Orlando, Jacksonville, Tampa, and Miami. We'll be doing Atlanta, Charlotte, Nashville, and New York City. And the goal is within the next 3 years, we'll be in the 50 major multifamily markets in the U.S. So that's the events business. The objective there is really to bring the multifamily world together, to bring market makers together, thought leaders, professionals, and investors and landlords and would-be investors. Because, as you know as much as me, those events, what you learn and who you meet, it's priceless. So, and, we really want to be the organizer of the community of multifamily. The second thing that we do is we have a college called the MREX College. Right now it's only in French, in the French part of Canada. But we teach multifamily real estate financial engineering. So we have a 2-course certificate of that. And we have a real estate multifamily entrepreneurship program. And we also have a 6-month mentorship program called the Wolf Pack, which is it's a very, very high level, intensive 6-month program with only 30 investors. There's nothing like it in North America. When you go into that program, number one, have to be very, very serious in multifamily as an owner or as a syndicator. And the goal is to just give you 5 years of experience and education within 6 months. So that's the MREX College. The idea when I built the MREX College, initially I didn't really want to do education in multifamily, but I just was so I just felt so annoyed by the poor quality of education in multifamily. So I was like, okay, I have to do this. And it's kind of, the goal is to build like a Harvard of multifamily real estate, but that's accessible to everyone. That's not, an elitist place, but where every property owner or syndicator can get access to top level education and knowledge. And then the third and fourth aspects of our business of the MREX, the third one is a platform. So it's a web platform. That's the core goal of why I built MREX, is that within the next 2 years, we're going to be launching a platform, which is going to be a platform that's going to centralize and organize the entire multifamily space. Because what initially brought me to founding the MREX was that as an investment banker, two problems kept on coming up. Number one is that, I have investors who are cash rich, who want to invest in multifamily, but there's no one place where I can see all of the inventory that they could buy, right? Because everything's fragmented. I mean, yes, there's properties on LoopNet and 10X and MLS and and Zillow and Truly and all these sites, but the fact of the matter is that there's probably only about 30 to 40% of transacted properties that are on those sites. And of those properties, you have to go and browse 6 to 10 websites. And each website has a different way of organizing and showing you the information of that property. So it's very time consuming. I find it very frustrating personally as someone who's researched a lot in the acquisitions business. And it doesn't really make any sense when you consider that, hey, if I want to buy groceries, I go to the grocery store, right? If I want to buy shoes, I go to a shoe store. If I want to buy tech stocks, I go on the NASDAQ. But if I want to buy multifamily property, there's no one place where I can go that everything's there, including on-market properties and pocket listings and even off-market properties that aren't for sale, which is, about 40 to 60% of the market. So that first premise is what brought me to want to build the MREX platform. So what we're going to do is we're going to organize every single property on that platform to create a centralized marketplace. And then off of that, obviously, we end up with so much data, because as a multifamily investor right now, if you want to buy property, you don't really have access to that much data. Like, CoStars of the world and Reonomies and all these other companies, they're doing very raw data, very, they're organizing raw data, but you don't have data that you can actually make investment decisions based on, because there hasn't been many algorithms built off of that data because they've had so much trouble just acquiring the data in the first place. So this is really the next step in big data in multifamily real estate. So these are the two things that we're going to build for real estate investors. We're going to give multifamily investors access to this platform, access to these tools in order to help them make better decisions in portfolio management, in acquisitions, dispositions, and refinancing. So that's pretty much in a nutshell. The fourth part of it, if you want to talk about it maybe a bit later, it's a very tech thing. It's on the blockchain. We're pretty much going to create a stock market based off multifamily properties. But that won't be coming out probably for another 3 to 5 years. So.
Wow. I appreciate
it's
you.
It's a mouthful.
Yeah, it is a mouthful. I want to tell you about an upcoming real estate investing conference hosted by my good friend, Joe Fairless. Every February, Joe brings his best ever conference to Denver, which brings together the top high-level experienced real estate speakers and sponsors that has proven to be the best ever networking, content, and strategies to help grow your portfolio. The earlier you buy, the more you save. Ticket prices increase weekly, so you want to buy today. I attended in 2018, and I can guarantee you do not want to miss this conference. February 22nd and 23rd, 2019 in Denver. Go to besteverconference.com to reserve your seat today. That's besteverconference.com and use hashtag Whitney to save 10%. That's hashtag Whitney. So how do you all know where you're wanting to invest? How are you finding properties, markets, and your thoughts on the cycle, the market, and things like that?
Right. Well, obviously, I'm not doing as much investing now. I'm more passive, to tell you the truth. Up here, personally, with my own funds, I'm a passive investor. So I'm just an LP now. I actually invest behind some of my top students who have come through the MREX College, who are really strong syndicators now and who really know what they're doing. In the U.S., I've acted more as an ultra high net worth individual advisor. So the way that I work most in the U.S. and also when I was an investment banker in Canada, obviously you really have to the one thing that people forget about multifamily real estate is that, yes, there's the macro of it, and that's very important. You have to be in tune to what's going macroeconomically. How is job growth going? How is rent growth going? What's happening to vacancies and all that stuff? And you want to look at different market cycles more at the micro level in relation to each other, right? So, I mean, the multifamily market could actually plunge in the U.S., but that doesn't mean that there aren't metro markets where the multifamily market will be doing very, very well, right? So that's where it gets kind of complex. So we want to look at both things. We want to do analysis at the macroeconomics level, but also at the micro-regional level, because multifamily can also be a very regional investment class. And that aside, you also have to do the whole financial engineering side of things where, if you're a syndicator versus just a private landlord, your deal structure is not going to be the same, right? A syndicator is going to have to go for more high value add markets, is going to have to go maybe for a bit more riskier markets that are cash flowing more, because obviously the more risk that you take on in multifamily, the more cash flow you'll have immediately, just because of that whole IRR, return on risk, return on investment versus risk profile of multifamily. So if you're a syndicator, which I am not really a syndicator. I've educated a lot of syndicators, but myself have worked more with private capital and private equity. So, we've done a lot of deals in more prime markets that we know that, yes, cap rates are low, cash flow is low, but that's because the market possesses very little risk. That's because there's a lot of liquidity in that market, meaning that there are a lot of buyers versus the number of properties in that market, which also means there's a lot of job growth, and that rents are going to continue to grow a lot, which is kind of making up for those low cap rates. Like, I take the example of New York City or Los Angeles or Miami, like any of the major metro markets. Yeah, cap rates are compressed versus Huntsville, Alabama. But the reality of it is cap rates are compressed in those markets because there's so much money in those markets that when you do need to get out of a property, you can get out of it fast, which means there's liquidity, and you won't have to you won't have to give a big premium. You won't have to discount your property that much to move out of it fast. So that liquidity premium is actually one of the major components of what a cap rate is. And also risk. I mean, what's the risk of New York City or Los Angeles or Miami? What's the risk of those markets plunging with regards to jobs and vacancies and rent growth versus Huntsville, Alabama, or Boise, Idaho, or versus Louisville, Kentucky? It's just not the same. And as international money starts to come into multifamily more and more now, what we're seeing, it's only starting to come into multifamily. Like, we've only started to see money coming in from Asia and the Middle East and Europe and even Africa and South America coming into the US, even coming into Canada, into multifamily markets. And that's only just begun. And what that does is you've got all this capital coming in, which continues to compress cap rates. And where does this capital go? It doesn't go to Huntsville, Alabama. It doesn't go to Boise, Idaho. And it doesn't go to Raleigh-Durham. It goes to New York. It goes to Seattle. It goes to Montreal and Toronto and Vancouver. It goes to LA and Miami. So that means that, yes, cap rates might be very low right now, but the rent growth, even if the cap rates stay stable or even actually elevate with the market, the rent growth will probably outplay those cap rates. And that's an important word I just said, probably, right? Because no one has a crystal ball. I don't have a crystal ball. Dr. Mueller out of Colorado, who's the major expert in real estate cycles, or Dr. Lindman out of Wharton, who's one of the major experts in real estate cycles. No one has a crystal ball. I don't have a crystal ball. We're making educated guesses, and we're hedging our bets. So I think that's what you want to do, is you want to hedge your bets. And the best way to do that for a smaller investor or for a syndicator is through active portfolio management. That means that when you do your pro formas and your underwriting at acquisition, that's only the first step. You should redo your pro formas and your underwriting constantly, every quarter, every month if you can. And that way, your predictions become less and less predictions as you advance in time, and therefore they become more precise, which also allows you to kind of, reset certain things or make certain protective moves in case your initial predictions of the market were off. So I think that's really where there's a major distinction to be made, because multifamily investors historically, even active investors, have always been very passive, meaning that they analyze the acquisition, they buy the property, and then they manage it. And then they only redo their financials when it comes to refinance in 5 years. And then they're all surprised when, especially now, when cap rates are lower and interest rates are higher, and now maximum loan amounts are getting lower, and they're getting played out of their own properties. So I think that was a long-winded answer, but ultimately that's the answer to your question.
No, I like that active portfolio management. I haven't had anyone talk about that, and that makes complete sense. I appreciate you bringing that out. But a few questions before we have to go. But tell me, when somebody just says, Nikolai, I want to get into multifamily syndication, what's the one thing you tell them, the first thing they need to do? Besides educating themselves.
Yeah, because educating, obviously, if you're going to if you're going to be a GP, you better make sure that you're way smarter than most people when it comes to multifamily, or that you have the opportunity to put people around you who are way smarter than everyone else. So if you're not a great underwriter, you better make sure that in your general partnership, you have a really solid underwriter who's there with you. So that's the first thing. The second thing is it's probably going to take longer than you think it's going to take. So macro patience, as Gary Vaynerchuk says, but don't prevent that from getting going right now and getting as fast as you can in the micro of it. It's going to take longer to raise the capital. It's going to take longer to build relationships with LPs. People think that just because they go networking here and there, and they go to some, big awards gala, or they go to a fundraiser, they're going to come out of that fundraiser with a new limited partner. You have to be very patient. It takes time to build relationships. So that's, I'd say, the first thing I'd say after education. Under promise and over deliver. Too many syndicators are over promising. Because they think that they have to do that in order to attract limited partners, because they're being impatient in the attraction of limited partners. Whereas if you're more patient in the macro and you understand that it's going to probably take more time to build up your syndication, therefore don't fall into the trap of being a shyster and falling into that over-promising, come to my fund because I'm going to give you 20% IRRs, I'm going to give you 9% cash on cash annually and quarterly dividends, because that's going to play you out of the market, because number one, that's not what the market is giving right now. And number two, it's going to put your investors' money at risk, because it's going to make you do deals that you wouldn't normally do, because you have now that added performance pressure. So I'd say that's probably the thing that I see the most, and that I advise syndicators to keep in mind as they advance in their careers.
Give us something that you've done recently to improve your business that we can all apply to our multifamily syndication business.
Letting go. I try to make myself as dispensable as possible in my business, which obviously is a very hard thing to do, especially being I've been a CEO for 12 years, and obviously I've always been in very innovative things. And once again, I'm in a very innovative market, but I think you can innovate a lot in syndications also. I think obviously a lot of syndicators are doing the cookie cutter approach, but there's a lot of cool things to do in syndications, especially when you understand financial engineering and multifamily. So I'd say learning to let go, learning how to delegate, and understanding psychologically and emotionally that, it's better to build an organization around yourself and have a smaller piece of that pie, because the pie is going to be way bigger in the medium and long term, and it's going to be way better. And ultimately, it's going to be a lot more fun, because you're going to be able to share your success with more people. You can also be able to share your obstacles with more people, and then that way those obstacles won't destroy you. They'll make you stronger. So, and delegating and sharing that success, even though a lot of people talk about it, ultimately it's a very, very, very hard thing to do, because as an entrepreneur, you're kind of a jack of all trades, and you're a perfectionist. So that that if I pass the ball with regards to, say, underwriting, that person I pass it to might not be as strong as me in underwriting, but I can't underwrite and raise capital and search for properties and take care of my health and my wife and my kids and actually live my life and do all this other stuff and write articles and do podcasts if on top of that I have to spend the day underwriting. So my underwriter might be only 85% of as talented as me, but hey, that's 85% of a lot more hours. So it ends up making up for it in the long term. So I think that's the number one thing that I've really done good at. It's taken me 12 years to really start to get good at delegating. So once again, you have to be patient with it and ultimately patient with yourself, which is the toughest thing to do.
Nikolai, you've been a great guest. You provided so much great content. Tell the listeners how they can learn more about you or get in touch with you.
I'd say at the moment, obviously the MREX's website is only in French, so a lot of you are going to be very disappointed when you go on the site. It doesn't matter. Keep it in mind. It'll be in English for the start of the year, so www.mrex.co. So that's MREX.co and not .com. The easiest way to keep in touch with me is on LinkedIn. Add me on LinkedIn. I'm very active. Add me on Facebook. If you go into Facebook and you type the real Nikolai Ray, I have a page. I post in French and in English, so don't worry. Everything's there. I'm extremely active. I have, all in all, probably about 25,000 followers on LinkedIn, Instagram, and Facebook. And Instagram, I'm quite active there. So, the three major social media sites, you can join me there, and it'll be my pleasure to share all the knowledge I can in the time span that I have available.
Great. Thank you so much, and the value you've provided to the listeners. I hope each of you will connect with him on LinkedIn and Facebook, and so you can learn from him and figure out where his events are. And I hope you will join me on my website and schedule a call so I can help you any way I can, and go to the Facebook group and join so we can all learn together from experts like Nikolai. So have a great afternoon. We will talk to you tomorrow.
Thanks, Whitney.
Phoenix Syndication Workshop 2019 is a premier educational and networking event hosted by noted real estate investors Ben Leybovich and Sam Grooms. PSW is a 2-day event being held in Phoenix, Arizona on January 26th and 27th. The first day is dedicated exclusively to nuts and bolts underwriting training. Ben and Sam will give a detailed presentation of their approach, technique, and underwriting model, which allows them to pick out the best deals in this very competitive environment. A recent case study will be utilized as a basis for this training. On day 2, the attendees will learn from industry professionals. Ben and Sam will be joined by a mortgage broker, property manager, and an attorney to answer your questions. As a bonus, everyone will visit the property to experience the process in action. This type of in-depth and actionable access is truly rare and invaluable. Ben and Sam are passionate about giving back, so 20% of the gross revenue from this event will be donated to a nonprofit. Register for the Phoenix Syndication Workshop by visiting justaskbenwhy.com/Phoenix.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.